It seems to me that at least in these four recessions, the credit cycle leads the business cycle. Private equity owned companies have like a shadow default rate of around 6%.
This podcast is for informational purposes only and does not constitute investment, legal, or tax advice. The views expressed by the host and guests are their own. Listeners should consult professional advisors before making any investment decisions.
Welcome to Fixed and Floating, the credit podcast. I'm Josef Pschorn, and in each episode we explore the forces shaping credit markets. Today, I'm joined by Professor Edward Altman from NYU, the creator of the C-score and one of the most influential thinkers in corporate credit research. Ed, welcome to Fixed and Floating.
Thank you very much, Joseph. Happy to be with you.
Great stuff. Ed, you have been studying lending and distress for more than 60 years now. What has changed over the last 60 years?
Well, a great deal. The capital markets, and particularly those related to fixed income and credit, were very primitive back when I first started studying the markets and when I built the original Z-score model, which was 1967 and published in 1968 when I was a graduate student, actually, at the University of California, Los Angeles. Basically, the only means of financing for companies in the credit markets were coming from banks and some small number of financings coming from accounts receivable financings, some factoring, but the markets were quite limited. And when it came to less creditworthy companies, they didn't exist at all. It was very difficult for a non-investment grade company to get financing at all, certainly not bonds and not syndicated loans, but maybe just very high interest rate bank loans. Then over time, the leveraged finance market, and we go to the next slide, we can look at the current situation on leveraged finance, and I can talk about the evolution. Yes. So the leveraged finance market, as I define it, basically this is the financing for non-investment grade companies. The next slide, you can see the breakdown of bond ratings. And if you go to that, you can see at the bottom half of that slide, you have the so-called high yield or junk bond market. That did not exist until essentially the late 1970s, when Drexel Burnham and Michael Milken pioneered in the United States the issuance of corporate bonds to financial institutions and wealthy individuals directly, rather than the traditional way of getting a non-investment grade company was to buy it in the secondary market after they've been downgraded from investment grade. You can see that back in the left-hand side, the high-yield bond market was about $10 billion back in the early 1980s. And at that time, Drexel had just introduced the idea of selling these bonds, floating these bonds directly to the public as an initial public offering of non-investment grade bonds. Back then it was 10 billion. Now it's 1.5, 1.6 trillion. The second category of leverage finance is the so-called leveraged loan market, or sometimes known as BSL, broadly syndicated bank loans. That market is about 1.2, 1.3 trillion now in the United States, and is growing very fast, not only in the US, but in Europe as well. And then finally, you have what has many names to it: direct lending, non-bank loans, private credit, uh, shadow banking. These are all names given to this new market, and it's relatively new compared to the others, and non-traditional market of private credit, which is growing much faster and is now exceeding probably more outstanding than the combined high yield bond and leverage loan market. So we estimate around 2.5 trillion. Some estimates from investment banks are somewhat lower. Together, leverage finance in the US is about $5 trillion outstanding. And I'll show you data a little later on. In Europe, it's probably about 400 billion euros. So, and it used to be quite a bit in China, but now with the problems they've had with their real estate market, it's now much, much less. But altogether, leverage finance in the US is about $5 trillion and growing, particularly the last category, direct lending.
It is very striking that after 2014-15, growth has pretty much stalled for the US high yield bond market. Whereas at the same time, private credit has started to accelerate, I think, what we see later. Do you think that the growth of private credit has come at the expense of the US high yield market?
Absolutely. That's a very sound observation, Joseph. Also, by the way, uh, at the expense of traditional bank loans. In fact, in the United States, if you looked at the total credit allocation, only 20% of credit now is coming from bank loans. 80% is coming from bonds, syndicated structured finance, and private credit. And so your observation of the leveling off, if you will, of high yield bonds and to some extent leveraged loans um, is mainly the fact that companies are switching or moving much more aggressively into the private credit market at the expense of traditional leverage finance. And that, I think, is one of the reasons why, and this may come as a surprise to some of your listeners, one of the reasons why banks themselves are now lending to private credit funds. And we will see in a few minutes some slides that show that and how that is structured. Because the banks, especially when reserves were quite high, and I'll come back to that in a moment, banks were at a big disadvantage in terms of lending compared to its competition from private credit, which do not have much regulation and reserves that are required. They do hold reserves, but that's very much idiosyncratic to the individual lender rather than required by a regulator. And as a result, banks now are very much aggressively asking their regulators, particularly in the United States, the Federal Reserve, but I think it's going to happen in other parts of the world, for reduced regulation with respect to the amount of equity reserves they need to hold against expected and unexpected losses coming from lending to counterparties. And so we can expect now banks to become a little bit more competitive with private credit in the future. Uh, and it's probably one reason why some of the leading bankers are outspokenly now attacking private credit as a very risky asset class and one that probably should have regulation more and one that needs to be monitored very carefully by central banks, such as the European Central Bank, private credit. But right now, the situation is, as you observed, leveling off of traditional leverage finance, high yield bonds, leverage loans, and a growth, dramatic growth in private credit. I'll have some more to say about that growth soon when we talk about the true default rates of uh, these direct lenders. So that's a very good question and observation. Let's move on to the slide that deals with the fact that, again, in the United States, 87% of firms with revenues greater than $100 million are privately owned. Um, and that comes from two things. One, um, private equity firms are much more aggressive in the last 10, 15 years in taking firms private that were originally publicly owned through leverage buyouts and other leverage transactions. And also, many firms have decided that due to um, what kind of data they want to present to the public and how frequently, and dealing with a lot of regulation and a lot of bureaucracy, they prefer to be private rather than public companies. So, with so many private companies now in the US, and I'm sure it's true in Europe, private companies outnumber public ones dramatically. Comes the attraction that private firms are moving more and more toward private credit as a source of financing because they can structure the loans much more carefully than when it's publicly issued and goes through the SEC in the United States for regulation. Michael O'Rourke, he estimates now $2.5 trillion size of the private credit market, growing from about 1.2 trillion 7 years ago. So more than doubling to around 2.5. And some people estimate, and I don't think it's going to happen in my opinion, but some people estimate that that private credit market will double to about $5 trillion in 5 years. I have some concerns about that growth, which I can articulate when we discuss the issue of the symbiotic relationship between private credit and private equity firms. I might as well mention it now. So um, there's no question that almost all private credit is coming from companies that are now owned by private equity firms. So private equity firms are the sponsors. They have a continuous and very ample supply of loans coming from private credit firms, and they build up this relationship. Uh, while the interest rates are probably somewhat higher than on bank loans, um, the bank loans themselves have been reduced, particularly for non-investment grade companies. That slide shows the allocation of private equity firms and their own ownership of private credit firms. So you can see that, for example, Apollo is a fairly significant private equity firm with about 150 billion assets under management, uh, but has almost 700 billion in private credit. Blackstone, about 400 billion in both private equity and private credit. So what that means is that the private equity firms have seen through subsidiaries profitable operations in the private credit field, as well as owning companies. And many of their companies then borrow money from their own subsidiaries or from similar private credit firms. Now, the private credit firms, a good number of them are what's called BDCs, Business Development Corporations. The banks not only are competitors, they are also investors in private credit because they see that that is a growth area and one that they feel up to now, I guess, that the risk return trade off of making loans to private credit firms makes sense, even if they have to hold reserves against those loans. And you have both long term and short term uh, lines of credit, et cetera, to the master fund. And that percentage, while does not at this point, in my opinion, provide a systemic risk to the banking sector in case there is a meltdown in private credit, the growth rate in uh, uh, loans from bank borrowing, it's gone from under $50 billion in 2020. And the last data I have on this is 2023, when it was about 130, 140 billion. Um, um, it's much higher now. It's probably about, my estimate, bank loans to private credit are in the vicinity of $400 to $500 billion, which in the big scheme of things is not huge, but certainly growing a lot. So it's an
Ed,
indication of this competitor investing as well in private credit.
yeah, so it seems that lending to BDCs is a very capital efficient way for banks to make loans, right?
Quite so, especially if the private credit firms have a high rating themselves,
Yeah.
which most of them do, the big ones anyway. I am concerned about the quality of some of the new entrants into the private credit area. The number of private credit firms has grown a lot of late. And whenever you have a lot of growth, you probably have some newcomers who are not as sophisticated, not as well financed, and not as profitable as the big guys that are already in the market. And if there's going to be a meltdown in private credit, it probably will happen first with some of these new entries. But that's just uh, a general observation on my part. I like to present uh, the credit cycle in a very simple way. And so if we look at the slide in front of you, you can see I've broken up the credit cycle into four categories of spectrum, from benign to average to stressed and then crisis. Now, that's just my way of doing it. It's maybe quite simplistic, but let me explain what the thinking behind it. A benign credit cycle is one that is very conducive to lots of liquidity, lots of lending, low interest rates, low default rates, if there are any defaults, and if there are defaults, high recoveries, and low risk premiums on the part of investors' requirement. In general, a great market for growth in in credit, and that has been typical of the U.S. market after the great financial crisis ended in 2009, 2010, and for the most part, although not with some hiccups, until 2024. And maybe a little bit when COVID first started. We had a big meltdown in credit markets and equity markets, as everyone knows, but it only lasted a few months. So that's the benign. Average requires you to have historical data so that you can compute an average. So if somebody asked you, what is the average default rate on a non-investment grade credit in corporate bonds or in leveraged loans or now in private credit? Could you answer that question? The answer is no, unless you had data going back, in my case, 40 and 50 years. So average would be, for example, for the high yield market, a default rate of about 3.3% per year. 3.3% of the outstanding amount of high yield bonds on average has been the default rate for the last 40 years. Of course, some years much higher. In crisis situations, it goes to well above 10%. Then after the average, you have a stress situation where default rates increase, interest rates increase, recoveries decrease, required spreads on the part of investors increase, and in general, it's a less liquid, more stressful market for both firms raising capital and investors incurring probably losses as interest rates go up and prices go down. And then finally, you have on the right hand side, you have the crisis situation. Now, I don't have time in this presentation, Joseph, to go through all the metrics that we look at to determine where you are in the credit cycle. But as you could see from the slide in front of you, we have some examples of the default rate in the benign, average, stressed, and crisis situation, the recovery rates, the OAS, which is the option adjusted spread required by investors. So these are guidelines that I use, and maybe your readers might be interested, to determine where we are in the credit cycle. Now, let me ask a question for your readers and yourself to think about, and then let's try to answer it together. And here's the question. Does the credit cycle lead or lag, or is it coincident with the business cycle? Most of us know what the business cycle is all about. Expansion, recessions, GDP growth, inflation, unemployment, many macroeconomic metrics to determine the health of an economy. Who leads who? Does the business cycle lead the credit cycle or vice versa, or are they coincident? So that's my general question to everyone who's listening. And maybe since I can't actually ask you to raise your hand as to which one you believe is the correct lead lag relationship, the next slide highlights the last 4 recessions. And although it's a busy slide, let me explain what it seems to me it shows. In each of these last 4 recessions, with the possible exception of COVID in early 2020, you notice that the default rate, the solid line, goes from below the historic average, below that 3.3%, to above it, in some cases 2 and 3 years before the recession starts. And then it continues to increase to crisis levels in several cases. In 1991, 01, 02, and 08, 09, you could see that default rates jump to above 10% for 1 or 2 years. So it seems to me that at least in these 4 recessions, the credit cycle, namely default rates in particular, and I'll get to what we mean by defaults in a moment, leads the business cycle. And then if you fast forward to the right-hand side, question is the current situation. Well, the current situation is a little ambiguous, a little more difficult. And I'm going to get to this in a moment. But basically, here is my conundrum. Here's my concern with where we are today. On the one hand, the default rates certainly have increased dramatically from a very low level during 2021, 2022, and even 2023, when tremendous government subsidies and very, very low interest rates reduced the stress in the credit cycle, but it started going up from very low levels of under 1% to about 3% in 2023. And then you have 2024 and 25 in the high yield market, as I'll show you, actually declining.
What do you think is the economic intuition between what you just showed, so that credit
Yeah,
spreads? Yeah.
that's a great question. On the one hand, it's simply statistical association seems to imply that the credit cycle leads the business cycle. Um, I my economic interpretation of that is that there are cracks in the economy that show up not in GDP recessions, but in default rates of marginal and then more increasing number of companies. And I think some of that is happening in the United States as we speak. But it's not happening for bonds. And I'll show you that in a moment. The bond default rate is considerably below the historic average. So it's not leading, in case we do have a recession, it's not leading. However, there are noticeable cracks in our economy, and I think in most economies in the world today, about increasing bankruptcy rates and default rates, particularly for firms that have floating rate debt outstanding. Because with inflation on a global basis, and the US and Europe are certainly no exceptions, of in the 3 to 4% range today. It's not huge, but it's much higher than the target 2% rate of most central banks. With the default, with the inflation rates being high, interest rates have remained, I wouldn't say historically very high, but certainly relative to what they were during COVID years and before and after COVID ended. Um, um, these companies that are borrowing from banks and um, um, even private credit are now encumbering and involving much higher default rates than bond investors where the interest rates are fixed. And since most of the bonds were issued during COVID, those fixed interest rates are very low and will remain low until they need to be refinanced, probably starting in 2027, 28. So, just for the education for those of you who are not as familiar with the concept of default rates, we have three types of defaults: bankruptcies, where all liabilities are in default. We have situations where a firm misses their interest payment or their maturity payment. It's not cured in the grace period. The grace period is usually 30 days for bonds and 90 days for loans. So it misses, but the firm has not filed for bankruptcy yet or is not forced into bankruptcy. It's still operating outside of the bankruptcy courts. And then finally, you have something on a topic we'll get to soon, distressed debt exchanges. And let me just give you a general definition of that, and then we'll come back to that in more detail. A distressed debt exchange is where the company, in many cases, a company owned by a private equity firm, but it could be just non investment grade, is quite distressed. And in order to avoid a bankruptcy, or at least avoid some very um, difficult situation in terms of liquidity, they their lawyers put out a tender offer to the creditors asking for certain of their bonds or loans to be restructured out of court. And what I mean by restructured is an exchange for new debt for old debt is the usual one, although it could be new equity for the old debt or even cash for the old debt. But the new package of securities in a distressed debt exchange has a value less than par value always than the original debt had. In other words, the creditor is asked to take a hit, but not nearly as big a hit as if the company would go bankrupt. So it might be, for example, to extend the maturity so that you don't have the maturity payment coming due very soon. Or it might be to change the interest rate. Or it might be to put in some new money, some new loans, or increase the priority of the loans to get a waiver on the part of the creditors so the firm will not go bankrupt. And these distressed debt exchanges, as we will see soon, have exploded in occurrence in the last 2 years. Altogether, you have three types of defaults, and that leads to the rating agencies and the investment banks and some statistical nerds like myself calling it a default. And that default rate then is aggregated for those three types and does so for the three types of leveraged finance: bonds, loans, and private debt. So, with that as a background, let's take a look at 2025. And that would be, yes, that's it. Um, and this is through the end of October. So it's not for the whole year, it's a year to date through 10/31 or 31 of December. So just to give you a quick summary, the high yield bond default rate is either 1.1% measured in dollars or 2.3% measured in number of companies. So it turns out that more firms are defaulting than if you denominate it in dollars, but both of them are below the historic average. If you go down below to the third line and you look at the leveraged loan default rate, however, it's about 3 times higher. Instead of 1.1% in dollars, it's 3.4%, where the historic average for the entire year is around 3%. And here we're talking about it's already at 3.4 and 4.5% if you do it in terms of numbers. So here is a stark example. And by the way, the same thing for the prior year, 2024, even more so, where you have a much higher default rate on loans than on bonds.
Ed, does this already include also distressed exchanges or these bankruptcies and missed
Yes.
interest paid? Okay, all three
Yeah.
together.
Yes, all three together. Right. In fact, the vast majority are exchanges in the last 2 years. But we count those as defaults because the creditor is clearly less well off than had been anticipated in the original contract, the original indenture with the borrower. And so we call that a default like everyone else in the market does. Now, direct lending down in the middle there only has a default rate up to now of around 1%. And I have to scratch my head and ask, how could that be? How could direct lending be as low or even slightly lower than the bond default rate and much, much, much lower than floating rate leveraged loans? Now, you have to understand where this data is coming from. And this was a big issue now in analyzing the health of private credit. All of this data is coming from publicly owned BDC statistics because that's the only statistics that are transparent for analysts. Firms that are publicly owned, that are direct lenders, must report on a quarterly basis to the SEC about their performance, including defaults. And so if you aggregate the defaults and divide it by the amount outstanding, you get a very low figure. Now, that figure is misleading, in my opinion. Two reasons they're misleading. One, it probably doesn't really capture all the type of stress in the portfolios of private credit. And I'll come back to that. But secondly, whenever you have a high growth rate in a market like private credit, the denominator in the calculation of a default rate is going to grow very fast. Let's say now the denominator is over $2 trillion in the US. But the numerator is defaults taking place this year. And so when you have a high growth rate in a market, that denominator will be very high relative to a more mature market that is not growing so much in the recent past. So what I'm saying is the calculation of default rates is not necessarily capturing all the stress in the system because it is biased by the enormous growth in the denominator. So that's one thing. The other thing has to do with the way private credit is able to mask the maybe true default rate in their portfolios. So let me now show you some data that perhaps provides that issue. Okay, so this slide is not that well known and was provided to me by a firm called Lincoln International. And what Lincoln International does primarily is make third-party valuations of the value of loans made by private equity firms. Of investments by private equity firms. So in other words, what's the value of their portfolios? But in addition, they monitor the covenants and information. And one of those pieces of information is known as a PIC, interest coverage or trend analysis, which is given in this slide. PIC means payment in kind. Now, let me explain how this works. On the left-hand side, you could see in 2021, 6.6% of all private credit had an option on the part of the borrower to pay interest in cash or to pay it in kind. Pay it in kind means you don't pay cash, but you issue new debt in place of the cash. And there is this concept, well, I'll get to it in a moment, called PIK toggles. It can toggle back and forth. The firm can pay interest, but if they have cash flow problems, they can pay in kind by issuing debt in its place. So the percentage um, of these uh, private equity owned companies that have this option has grown from 6.6% to over 11% in 2025. So think of it that way. At least 11%, it's probably more today, have, maybe it's up to 15, 14, 15%, have the option. On the right-hand side, we could see how many of those firms that had the option have switched from cash to pay in kind. And that's a sure indication of a stress situation for the company. When they no longer have the cash to pay their interest, they switch to paying it in kind. And that has gone from 33% in 2021 to over 50% in 2025. In other words, more than half of the companies that have that option have switched. And we call that a PIK toggle, Toggle. And if you multiply that 53% by 11% that have the option, you have like a shadow default rate of around 6%. In other words, shadow meaning it's not usually calculated as a default, but it certainly is a measure of stress. And to me, that's a worrying sign about the health of an increasing number of the portfolios of these private credit firms. But they are not formally considered a default, this so-called bad pick situation. I hope that's clear. If not, if you have questions about it, you can certainly write to me afterwards. So bottom line, with respect to private credit, on the one hand, it's growing dramatically. It's by far the largest amount of credit outstanding.
Ed, you did a lot of research on how to dissect the types of defaults. We can split them into three, like bankruptcy, missed interest or maturity pay, and distressed debt exchanges.
Right.
Why do you think distressed debt exchanges have taken such a large share of overall defaults?
Well, that's a very important question. And the data shows this, particularly starting in 2024 and continuing in 2025, when over 70% of defaults were distressed debt exchanges, and the remaining were either bankruptcies or missed interest payments. So historically, it's been um, around 10 to 30%, depending on the year, of distressed exchanges. And then it skyrocketed to over 70% for both bank loans and for bonds in 2024. So that gives some meat, so to speak, to the data on the increase in popularity, if you will, of distressed exchanges. So now, a distressed exchange, as I mentioned before, is a method for firms to um, avoid going bankrupt. So it's an out of court which makes it less expensive, much quicker way. But basically, it's a fix only to the capital structure of a company. It doesn't cure easily the operating problems of a company. And the exchange is, as we talked about before, new debt for old debt for the most part. Now, if there's more stress in the system, you would expect firms, especially since they want to avoid the high cost of restructuring and bankruptcy, and do it out of court quicker. The second reason is that we have now the phenomena called liability management exercise, which is a nice term for a not so nice term called creditor violence. And what that means is that one group of creditors tries to take advantage of their size and cooperation to the expense of a minority group of creditors. Why? Well, on the one hand, on a positive note, the group that is the majority, more than 51%, is oftentimes willing to put new money into the company, mainly in the form of new loans, but it could be equity as well. And therefore, they want certain privileges should the firm go bankrupt later on. In other words, have a higher priority in terms of the pecking order of getting paid first by providing this loan extra money the hand, and also by eliminating the participation of the minority. And the lawyers who have put together these exchanges that have the liability management option involved in it have decided that even if the firm eventually will go bankrupt, let's do what we can for one group of creditors at the expense of another. And so far, the courts have sanctioned these exchanges, not in all cases. There have been some cases where the courts have ruled against the majority forming this cooperation group at the expense of the minority. But basically, most of these have gone through, at least up to now. And that has made the distressed exchange option more attractive, not only to the majority creditors, but to the owners of the company, the sponsors, namely private equity firms. Because the owners see the exchange as a type of call option on the equity of the company, giving them more time to perhaps correct the problems, kicking the can down the road, so to speak, in terms of problems by, for example, extending the maturity of the loans, with the option that the firm may, in fact, recover. And that's very valuable as an option for the owner and for the majority creditors. Finally, to answer your question, Joseph, another reason why I see this jump in 2024 and 2025 in distressed exchanges is the fact that the higher interest rates, particularly on bank syndicated loans, have kicked in to the point that these firms need some assistance to stay alive. So the old a song by the Bee Gees, Staying Alive, is very much alive and kicking in the distressed exchange default arena of late. And I think will continue until one of two things happen. One, interest rates fall and floating rate debt is not as onerous. And two, it could be that new debt issued will have provisions in it that eliminate the possibility of a majority taking control of the situation through a distressed exchange. And I think both of them could happen. Um, One with better covenants, protections for all creditors, but a lot of creditors are smaller and less organized to provide that in a highly liquid market. So I'm not sure how quickly this will happen. And the other thing, of course, is if interest rates fall quite a bit, then the stress on those companies will go down and there'll be less exchanges. But to answer your question in a very long way, I think combination of higher interest rates and more aggressive liability management strategies have caused the distressed exchange percentage of defaults to skyrocket to over 70% of all defaults. And that leads us to the last question, which I'd like to get to, is what happens to these companies after they do an exchange? Does it work? Or do they firm have what I call significant second negative events? If we look at the entire period of distress exchanges from 2009 to 2022, and then follow the companies afterwards, both in terms of whether or not they had a second negative event, namely a bankruptcy or a distress exchange or a missed interest payment, or it didn't and it had no problems afterwards, we find that for the entire period, '09 to 2022, about 53%, a little over half of bonds and about 42% of loans had a significant negative event within 5 years, and most of them within 2 years. In other words, a lot of companies that do exchanges end up going bankrupt anyway. But it doesn't happen immediately. It could happen 1, 2, 3, up to 5 years, or even more afterwards. If you break the sample into most recent 7 years, that percentage of 53% goes up to about 60%. So 60% recently of distress exchanges that had mostly an LME element to it ended up badly. But not as bad as it would have been for the majority's creditors had they not done the exchange. In other words, they generally do better, although they suffer anyway, than the minority. So this dynamic is very controversial. It's very important because it's taking place so frequently. And I think it will continue to do so. And if you talk to professionals in the field, many of them feel that these exchanges were done in many cases by either the owner or the senior creditors, sorry, the majority creditors, anticipating that the firm would fail anyway. But it would take, maybe 1, 2, up to 5 years for this to happen. And in the interim, the firms are paying interest on their loans, and it's always possible for a distressed investor, which is my last footnote, to come in and buy the debt at a very reduced price after the exchange. And in some cases, maybe 40% of the cases, the firm never goes bankrupt. And so they really do very well by buying that distressed debt. And even if they go bankrupt, the recovery rates are pretty much consistent with what they would have been at the time of the first exchange. Sorry for such a long answer to the question of distressed exchanges. And let me add something, Joseph, about some new research that we are doing as kind of a footnote to this whole discussion of distressed exchanges, if I might.
Sure, please go ahead.
The footnote is there's more research to be done on this distressed exchange area. And one thing that we are doing is doing a kind of decision tree analysis of what the possible outcomes could be with an exchange, both success or non success, and the probabilities that these will take place, and comparing what the creditor could get if they sold the bonds at the time of the exchange or hold on to it through the post exchange period. And so we will present a decision tree which has probabilities and outcomes for decision making for various creditors and owners of companies. The final thing that we are doing is to look at whether or not a predictive model can be built at the time of the first exchange, predicting whether or not there would be a second negative event or not. I mean, if you can predict with high accuracy if a firm is going to make it after the exchange and concentrate on those that look like they're going to make it, you're going to do extremely well, particularly as a distressed investor, but also even for uh, the various bondholders and loan holders. If it looks like the firm is likely to go bankrupt anyway, then you have to decide when is the optimum time to sell. Because clearly, if you hold it until bankruptcy, your recovery rates are going to suffer the most. So that kind of ends my discussion of distressed exchanges. It may be a little long winded and complicated for some listeners, particularly in a market that doesn't have distressed exchanges, but um, you could argue that distressed exchanges are coming to all markets. It maybe take a little bit longer for it to come to Germany and France and Italy than it did in the United States.
It is already here in Europe, so I think
Oh,
that
okay.
the interest is very high in Europe as well. Similar situation, not as bad as in the US, but it's still very, very present. Um, One question from my end. Your sample or the last sample you presented on distress exchanges, that covered a very benign environment. So we had no real recession. But how would distress exchange outcomes differ if we would go into a recession? And I think you pointed out that usually recoveries are much lower in a recession than in benign periods.
Correct. Well, if we go into a recession, especially if that recession is preceded by an increase in default rates from the credit cycle, um, then um, there's no question defaults will increase of all types, bankruptcies and exchanges in number. I think the percentages of firms, um, that do exchanges will probably come down somewhat, and the percentage of bankruptcies will go up during a recession because the market will not be as likely to support the exchange, or the recovery rates will be lower anyway. And the reason why recovery rates, by the way, will go down during a recession is supply and demand. If you have a large number of firms defaulting at the same time, the supply of distressed assets will go up, and with a limited amount of capital buying distressed debt, um, uh, you can expect prices to come down, and vice versa in expansion. Um, so uh, I would say that the recessionary period will certainly increase all measures of stress. Um, with the great increase in private debt, it will be interesting to see what happens to default rates in private debt. But I would expect their default rates to go up. And if you then look at the so called bad picks that we talked about, that percentage will also continue to go up as firms increasingly exercise their option to pay in kind. Um, uh, I'm not predicting a recession. That's not my specialty. But the dilemma I have, and I'll repeat it now, Joseph, is, do I look at the high yield market or do I look at the bank syndicated loan market as an indicator of the credit cycle? If I look at the bond market, it doesn't look like a recession. If I look at the loan market, there are some indications that there's more stress in the system than we had thought, and that recession is more likely. Um, and so that's all I'm saying is now, since bank syndicated loans are much more prominent now, although not as much as floating rate private debt, I think there is, from my opinion, an increased likelihood of a downturn in the economy in the U.S. And a higher uh, likelihood of us moving from an average to a stress situation. I would say right now, the credit cycle, we're somewhere between average and the beginning of stress. Uh, but you never know it if you only look at the high yield bond default rate. Hopefully, that's not too convoluted of an answer.
Ed, that was great. Thank you so much for giving a masterclass in how to think about credit cycles and how to think about credit risk. Where can listeners find more about your work and also get your latest article, Unlocking the Credit Cycle?
Oh, well, that's a good question. I'm not as well organized as some of my colleagues. Certainly, I have a website at NYU Stern. Um, if it would be okay with you, I can send you, and maybe you're familiar with the credit cycle article. I can send you, and you have a copy of the distress exchange article also. I give you permission to send it to any of your listeners, and you can take the burden off me and pick up some of the burden yourself. At least, and those two, I would recommend somebody who really wants to be a student of credit risk and credit cycles and credit discussion to get our 2019 published book, which is basically, of course, could be updated with the data that is in the discussion today. It's called Corporate Financial Distress, Restructuring, and Bankruptcy.
Perfect. Thanks, Ed. And also thanks to everybody listening to Fixed and Floating. Please subscribe wherever you get your podcasts.